Good afternoon, everyone, and I'd like to thank you for joining us today. My name is Jodie Brockman, and I'm one of the Community Health and Wellness Coordinators here at NKC Health. Today we are here to have an educational offering entitled Risk, Credit, and Debt Management. Whether you hope to gain the knowledge to make informed financial decisions while also assessing your risks, or you're working on building and maintaining strong credit, or maybe you're needing to manage debt more effectively, you're in the right place. Please let me introduce our presenter today. Some of you might know him from last month, John Bright. He is with the Opus Group. John is a seasoned financial advisor with deep roots in the Northland, now living in Kearney with his wife and 2 daughters. John brings a thoughtful, client-focused approach to wealth management. Known for his keen ability to identify opportunities and his approachable nature, he helps clients navigate their financial journey, whether they're growing their investments, securing their legacy, or planning for a comfortable retirement. His knack for simplifying complex financial concepts has made him a trusted resource for many families. But above all, John is passionate about guiding individuals through meaningful financial conversations. So let's give a warm welcome to John Bright as he shares his expertise with us today. Hey, John.
Hi. Yep. Thank you, Jodie, for that introduction. I really appreciate you guys having me on again. For the audience, hope everybody's having a great day. As Jodie said, I'm a financial advisor with the Opus Group. In the last couple episodes, we've covered a few great topics for building your own personal knowledge when it comes to your personal finance. Today, we're diving into another 3 core areas of personal finance that are big. A lot of us have experience with those, for good or for bad, and that's credit, debt, and risk. These areas can make or break your financial well-being, whether you're just starting out, rebuilding, or rebuilding. This session is designed to give you practical steps to take control of your life and build confidence in your financial future. So, jumping off into this, we're going to start with credit. So what is credit? Now, some of you probably already know this, but just to start off from the beginning so that we have a good baseline understanding of this, what is credit? So credit is your ability to borrow money and pay it back over time. Typically, you're going to borrow this from a lending organization. So this could be a bank, it could be a credit card, but those places where you're using credit, where other people are paying for the things that you're either purchasing or the payments you're making, and then you owe them and you're paying them back. So your credit is tracked by a credit report and summarized in a credit score. So some common types of this is FICO or Vantage score. Typically, credit scores range from 300 to 850. Now, in that, the higher the score you have, the better. So when you're managing your credit, you start looking at the credit score that you have. You want to start building those numbers if you're going to utilize credit in your financial picture. So why does credit matter? So credit affects your ability to get approved for loans, housing, and sometimes even jobs. Your credit impacts interest rates. So a better credit score reduces the cost of borrowing money. So everybody here at some point, you know, or maybe not everybody, but a lot of people are going to be looking at either they bought a house, they're going to buy a house, they'd like to buy a house. So in that, you're taking out a mortgage. Now, in that mortgage, they look at your credit score and they go and say, hey, what is the risk that we're taking, right? So the company that is loaning you the money is going to adjust how much money they're making off of the business deal based on your ability to pay them back. So the better your credit score is, the lower your risk is, or the risk to them of you paying back your money. So the cost associated with that is usually lower. So your interest rate will be lower as a result of having better credit. Now, what makes up a credit score? So there's a couple different categories that go into what makes up a credit score. I'll list them out here, but basically it's payment history, and that makes up about 35% of your credit score. The amount that you owe, currently is about 30% of your credit score. The length of credit history, how long have you been somebody who uses your credit, you know, how much debt do you have? And then this one is, how long have you had a history of borrowing and then paying back that money? That accounts for 15%. The credit mix that you have accounts for 10%. And then new credit inquiries accounts for 10%. So total that equals 100. When you're looking at this, there's going to be a few things that we'll get into here in a little bit that will be kind of tips on things not to do if you're about to use your credit for something. Because those in these categories that we just covered, like if you're going to go buy a house, then you don't want to go buy a car right before you buy a house, because if you're taking out a loan to pay for that car, that's a new credit inquiry. So that's going to drop your credit score. So for the bigger purchase, you're going to have a lower credit score, and that's going to hurt you financially by paying more interest. So just an example, we'll get into some more of that stuff here in a little bit, but there's three different groups of people that I would say that this, you know, that are affected, you know, when we talk about the credit conversation. You've got people who regularly use credit now. Now those people are using their credit cards or already have a mortgage or a car payment, and they're making payments on those, right? So every time that you're making a payment, you're building that credit history. Now, there's people that are already utilizing that. There's people who are against utilizing debt as a financial tool. So those people that are, hey, I'm debt free, I'm going to stay debt free. If I don't have it in cash, then I'm not going to buy it. And then there's people who are maybe either starting out or just getting into, hey, I want to build my my credit score so that the debt that I, I'm working on is going to be cheaper, right? So whether you're building credit for, taking out a mortgage or buying a car or something like that, those are kind of the three categories. So people that already use it effectively have been building their credit, people who are not going to be using it, people who are new to this. So starting out, for people that have no credit or people that have bad credit, how do you fix that? So if you have no credit, you're what's called credit invisible. So you don't have a credit score because you have no debt. You have no payment history because you have no debt. A lot of kids who are graduating high school, different things like that, they're going to have, getting out into the workforce, they're going to get out there and they're not going to have had any credit cards or any sort of debt payments that they, have been paying on. So for them, they're not going to have a credit score. Now, some adults, young adults, even adults that have paid for their houses in cash, stuff like that, they may not have a credit score. So here's a few different things that we can do to get you, if you're looking to build credit, like how can you do that? What are the steps? What are some pretty safe ideas to build credit? One of the things that's a precursor for this is credit can be dangerous. There's a lot of people who get into situations where they haven't taken the proper precautions of, setting up a emergency fund and having a cash flow that's positive. And in those situations, if you turn to debt, debt can jump up and bite you. By being over-reliant on debt, sometimes you're going to have situations where, especially with credit cards, where the interest rate is high, and the item that you bought or what you used the card for is going to cost you a lot more once you're utilizing, the pay down for that credit. So building your credit, what are some good options? There's a secured credit card. So this is a deposit-backed credit card used for small purchases, and then in that you pay them off in full monthly. That's one good option. One of the the items I want to stress on this is that by paying it off monthly, you're not going to have the interest rate build and compound on it, right? So this is not making the minimum payment. This is using it for an item. Let's say you bought, let's say that you bought a set of tires at a local place that sells tires, and they've got a promotion. If you get a card, a credit card, then you go ahead and put the tires on there and they'll give you a discount. Now, If you don't go and pay that off immediately, then the credit is going to be used to pay for the tires. You're then going to have interest built up on how long that's out there. So it could be like a 15% annual rate. It could be 20% annual rate, but the longer that you have that debt outstanding, the more credit is going to build up, more debt's going to build up because of that purchase. So you want to pay it off in full monthly. That's the key here. For some of those kids that don't have a big history of using debt, using credit, one of the things is if their parents are wanting them to be able to use credit, is making them an authorized user on one of their accounts. With some parents, right? Or it doesn't matter about parents, it could be a friend, it could be another family member, but you can add them as an authorized user. As long as they have good credit, then by making them an authorized user, their credit will then help that person to develop some credit, right? So you're using your credit score, the credit history that you have on whatever it is you're making them an authorized user on, will then be shared with the new person, right? So in this case, let's say there's a parent and she's got a son that's about to go off to college, and she wants to go ahead and help him start building his credit so he can get a better interest rate on either a loan for a house or a loan for student loans, whatever it is, right? So she can go in and add them as an authorized user. Now, as an authorized user, they don't have to use the card. They can just be an authorized user but not really have access to a card, right? That's something that that the mom or dad can work out with their kid. In that situation, your credit history, the person who was the original, card holder, would be shared with their younger person. So that's a good way to do it. There's also a credit builder loan, so you can repay a loan that is held in a savings account to build payment history. There's also using services like Experian Boost, which is basically reporting alternative payments. So alternative payments could be utilities, they could be streaming payments. So if you've got anything like that you've had an account for a while that you've been consistently making payments on, that may be a good option as well. One item that you could do, like the tire example I was using, you could start with a retail or a starter card. So that's easy to get approval for, but this is something you want to use responsibly and keep balances low, because typically these are not going to be fantastic rates. So now that's if you have no credit. If you have bad credit, here's a couple things that you can do. You can catch up on late payments. So if you have payments that you're supposed to be making, but you haven't been able to make those payments or forgot to make those payments, go ahead and catch up on the payments first. So payment history is the most important factor to your credit score. Another thing is if you lower your utilization, so keeping the credit card usage under 30% is good, under 10% is ideal. So if you can keep your payments on time, lower your utilization, so pay down some of that debt, get it under 10% of whatever you're approved to spend. So if an example is if you have a credit limit of 10,000 and you keep the balance at 1,000 or under, right? Let's say you pay it off before the end of every month. That would be the ideal situation. So you've got the payments, you're using the credit, but you are paying it off and you're not, utilizing a bunch of credit, because again, the score directly correlates to the risk that you represent to paying them back. So if you have a lot of debt out there, then that's something that they're going to hold against you. So another thing is dispute credit report errors. One of the things you can do is visit, a credit reporting site. One that we've talked about in the past is annualcreditreport.com. You can go on there to check for mistakes. And if there are any situations out there where you're like, hey, this doesn't look like something that was legitimate, then you need to report it. Go ahead and actually, dispute that so that you can get that corrected, right? That can be something that hurts you, even if it wasn't an accurate reporting of, a credit event. One of the things you can do is don't close old accounts. So the older credit lines help your credit history age, right? So the longer your credit history age, the better your score is going to be. So we've got catch up on late payments, lower your utilization, dispute credit report errors, don't close old accounts, setting up auto payments. That's another one. So to prevent missed payments, sometimes, you know, it can be as easy as, hey, I put it in the mail. I thought the mail was going to get there in time. There was a holiday, whatever the situation was, and the payment wasn't received. Paying by mail can be something that impacts you by, you know, having a missed or late payment. By setting up auto payments, you take better control over how you're making those payments, and generally it's electronically. So when that happens, you take all the guesswork out of it. You know the payment was made. You can see it go out of your account quicker, which gives you more control over, you know, having your credit score improvement in your own hands. So now we've covered credit pretty well. Let's go into some debt management strategies. So there could be some people out there that are saying, hey, I've gotten good at using credit, so now I've racked up some debt. So how do you manage debt? How do you control the usage? How do you make sure that you've got good debt versus bad debt? You know, making sure that you are managing these things is a huge thing. Jumping into good debt versus bad debt. So some examples of good debt could be a mortgage, right? You're buying an asset that should appreciate in value over time. So you're buying a house, let's say, for example, you're paying $300,000 for a house, and you're planning on living in that house, and over the course of time, that house appreciates to $400,000. So you took out a loan for $300,000 or whatever the difference was that you didn't have a down payment for. You go ahead and put that down, but you've got it on an asset that's appreciating value. One other thing, taking out loans for future income, right? So if you have either student loans or if you have a program that you're doing and you need that for a certain job that's going to, you know, get you to a higher paying situation, right? So more income, then that can be good debt. So be responsible with what you're using it for, but assuming that you can get a good job out of either utilizing student debt or taking a loan out to do a program, you know, career advancement in any way, as long as there's a good job that's marketable tied to that future income, makes it considered a good debt. Now, some people will tell you no debt is good debt. This is on the better scale of debt, right? So bad debt, this is something that you want to try and stay away from. Credit cards, payday loans for sure. So these are high interest and they're tied to consumption. So the higher the interest is, the harder it's going to be to pay it off once interest starts accruing. And when it's tied to consumption, we want to try and improve our cash flow so that we don't have to rely on the credit card holding it over for us, right? We want to make sure that our cash flow is in a good enough place where we can go ahead and if we use the credit card, go ahead and pay it off before the end of the month, right? So get the statement, pay it off. Signs of unhealthy debt. So only making the minimum payment. Some people, when they first get a credit card, they've got it set up to where they're only making the minimum payments. To stress to you guys again, you want to be paying this debt off as soon as possible. So if you have the money, go ahead and pay it off. Don't make minimum payments. Don't let that jump up and bite you, because what will happen is as you're making the minimum payments, interest is accruing. And generally the credit cards are going to be accruing more interest than whatever your money that's sitting in your savings or checking account is going to be accruing. Using credit to cover basic expenses. That's something where, again, we want to use our cash flow to go ahead and cover those basic expenses, right? So we're not becoming dependent on credit, right? Credit should be something that you use, but it's not something you want to be dependent on. Credit and debt tied together. Having a high debt to income ratio. So if you want to figure out what your debt to income ratio is, if you take all of the debt that you have, so if you have credit card debt, write that number down. If you have a mortgage, write that number down. If you have a car loan, write that number down. And then underneath that, you want to write, hey, here's the total of that. what income do I have? You divide what debt you have by the income that you have, and that's your debt to income ratio. Now, typically you want to have a very low debt to income ratio, because if you use too much debt, then again, it's going to put stress on you when you go to pay it back, right? If you have an income that's high and you have a debt that's high, that's still going to put stress on you over the course of time. If any little thing goes wrong, then you have a chance of it spilling into a bigger issue. So we want to make sure that we keep that debt to income ratio low. So assuming that you have debt, right, there's a couple different things. Obviously I've said, hey, pay down the debt, pay down the debt. Let's say you've already accrued some debt. What are some strategies, some ideas on paying down? There's two different ones that I like to suggest to people. I'll go over those first. There's the snowball method, which pays the debt first for the lowest amount, right? So if you have a loan that's $1,000 and you have one that's $5,000 and one that's $10,000, you're going to pay off the debt that's $1,000 no matter what the credit score, not what the credit score, no matter what the interest payment is on that. And you're going to pay that one down first, then you're going to use the money from that one and the one that you're paying on for the $5,000. You're going to go ahead and pay on that. Next, work that down, then go to the one that's the $10,000 and then pay that down. Now, during that, you're putting extra money towards the smallest debt first. You're still going to be making payments on the bigger debt, but you're reducing the smallest one, then using that extra money to then pay down the next one faster, and then the one after that faster than that. Now, the other option is the avalanche method. So the snowball method was the first one. Imagine rolling a snowball down a mountain. The further it rolls down the mountain, the bigger the snowball gets, right? So with the avalanche method, you're paying the highest interest rate down first, no matter what the amount is. So in the same example, if you have a $1,000 debt, you have a $5,000 debt, and you have a $10,000 debt, and the $10,000 debt is the highest percent interest that you have, then you're going to be putting more money towards that $10,000 to pay it down faster because it's costing you more. So in that strategy, you're paying down the higher interest debt first. I went to a private school up north of Kansas City, and I had some student loans. Now, as a private school, they had, several different, it wasn't just one big loan, it was several student loans. Now, when I went to go pay that back, some of them were like 3.4% interest, some of them were 4%, some of them were 5%, and some of them were up to 6.8%. So when I came down to, hey, I graduated, I got a job, I'm looking at this debt, I looked at it, and the 6.8% interest ones, I started attacking those ones first. And then I paid them down, got those taken care of. I was still making the payments on all the rest of them, but I was putting extra money towards those ones to pay it down first. Then after the 6.8% ones were gone, I went to the 5.5% ones, started paying those off. Now, once you get to where you paid off the higher interest ones, then you can start to, see the light at the end of the tunnel. But that's the way, if you're really looking for, hey, how do I save the most money? That is the way. But there's a lot of psychology behind the snowball method as well. So the intrinsic feelings that you get when you're making progress towards a goal is what the snowball method is based off of, right? If you pay off the smallest one first, you get a little bit of a boost. Hey, awesome, I paid this one off. Now you've got that much more motivation to go to the next one. So either of those are good. Obviously, the avalanche method, you're going to pay less interest in the long run, but the snowball method is still a good solution. Another one is debt consolidation. For some people that have high interest debt, sometimes they can combine multiple debts into one lower interest rate debt. So in that situation, you've got, let's say you've got a couple different credit cards, and then you roll it into either a HELOC or something else, just something with a lower interest rate. Well, you've reduced the percentage that you've got to pay worth of interest, but you've still got that debt, so you're going to be paying on it. But the fact that it's charging less interest is going to help you to pay it down faster. Another debt reduction strategy that I think is extremely helpful no matter which of those other three you use, is budgeting. So tracking your income, tracking your expenses, and then finding the extra within your budget, right? So you get extra income that you have and allocating that towards extra debt payments. That's going to be key, because as you're doing this, you want to pay more than just the minimum. You want to pay more than, you know, your normal budget until you can pay them off. That's going to be the key. Once you pay them off, you get them into a manageable area, then that's great. One way to keep yourself from getting into a sticky situation with that, and I mentioned this earlier, but I wanted to circle back around to it, is developing an emergency fund, right? If you pay, let's say you go and you use your American Express card and you make a payment and you don't have any money in the bank, you're waiting for the check to hit, stuff like that, then you're kind of in a sticky situation. If you budget, build up an emergency fund of like, let's say 3 to 6 months worth of expenses, then once you have that, if you go put something on the credit card, you've got that money to go ahead and pay it off and then replace what's in your emergency fund, right? So in that situation, that's the best way to do it, because you're still able to use the credit, but you're using it responsibly and paying it off immediately before it's going to severely affect you. So we don't want you falling deeper into debt. We want you to manage it, to basically use it without it affecting you in a super negative way. There's a lot of things in life that we see coming, and then there's some things in life that are unexpected, whether it's a health event, car troubles, right? Like if your car breaks down and you need to get a tow, and then you need to get your car fixed. Those are things that can come up, and if you don't have extra money that you've allocated towards an emergency fund, when you have an emergency, it's going to put a lot of financial strain on you, especially if you're not saving those extra funds, right? So that was a couple different ways that you can either, one, develop good credit, or two, if you have bad credit, ways that you can kind of start working on either consolidating or paying off and reducing your dependence on credit and reducing your debt. So the next thing that I want to go into is risk and risk management. So what is risk management? Risk management is protecting your income, your assets, your family from unexpected events. So in this situation, for my job, there's a lot of different risks that people can be exposed to. Some of them are more likely, some of them are less likely. But when you have risk out there, you want to try and manage it, right? So by having an emergency fund, you're preventing the risk of, unexpected expenses causing you to use debt, which can spiral if you don't have the money to go ahead and pay that down, right? So reducing risk from unexpected events, that's key. So what are the types of risk and how can you manage them? So income protection, there's disability insurance that replaces income if you're unable to work. There's life protection, so that's life insurance that ensures that your family can maintain financial stability. There's asset protection, so that's homeowners, renters insurance that protects against theft or damage. Auto insurance that protects you against liability, and then also for property coverage, right? So if you get in a car accident and somebody says, "Hey, you've messed up my car," you're liable for that if it's your fault in the accident. Well, your insurance is going to cover it. It's not going to come from you. So, those are the type of protections you can have. Also, liability protection. So there's what's called an umbrella policy. So that's a extra layer of protection beyond the standard limits. So the umbrella kind of covers over the other policies and gives you additional, liability protection, right? So if you were to get, let's say, a doctor who does surgeries is driving down the street and you have a kid, and let's say your 16-year-old crashes into them and they're impaired from doing their job. If they were to see you guys and it exceeds your automobile coverage limit, then you're personally responsible for whatever is left, right? So as you're looking at your risk in that situation, you've you're going to have either your assets taken, or you're going to have basically you're going to come out of pocket for the rest of it, whether that's through assets or money that you have. So that umbrella policy is covering you. That accident happens. If the umbrella policy covers the kid, then you'd have more protection against any sort of extra exposure. Now, umbrella policies are not specific to automobile or housing. It's over everything, right? So this is your personal liability that it's reducing. So ask yourself, if something happened to you today, would your family be protected? That's a key component to this, right? Like if everything goes to plan, everything happens the way you want it to go, then that's great. If something happened to you, how is that going to affect your family? So could they maintain their lifestyle without your current income? Or if your spouse, if something happened to them, would you be able to maintain your lifestyle without their income? All of these things are things that you want to progress towards, right? And by managing your cash flow, which is something we talked about in the first episode, with that, building your cash flow, building your reserves, building your emergency funds is a great way to start that. Another thing is that if you have insurance, you can go ahead and have that money replace what they would have brought to the table, right? So in my situation, if my wife passed away and we had no insurance on her, then it's just up to my income to make the family run, right? I may have to sell the house, I may have to sell the car, I may have to downsize, I may have to reduce my lifestyle choice. With that, you've got options, right? You can go get life insurance. There's tons of different kinds out there. That's something that we can help with if you're interested. But you've got life insurance, you've got disability insurance, you've got long-term care insurance. Long-term care insurance is something that later on down the road, whenever you are getting older or if something happens to you where you need long-term care, whether that's a nursing home or in-home care, that's something that is being more prevalent today with people who are living longer lives. So with that, you want to make sure that you're protected. People are living longer, so it's more likely, with people living longer that there is going to be an event that happens. So you want to stay protected because you're leveraging your money to where it's actually protecting you instead of, a dollar for care. You're using a dollar to buy $2 or $3 worth of care, right? So you're leveraging your money, and in a lot of ways, you're reducing your taxation, right? Like if you have to take money out of retirement investments, stuff like that, then it can cause a situation where you're getting taxed on that. So you take out, hey, I need $50,000 for this care. Well, depending on what your tax bracket is, you need to take out more money so that after taxes, you have the $50,000 to pay for your care. So that's something that's important. We want you guys to be protected, not only from insurance and all that, but we want you to do the things that you can do to put yourself in a good position so that your not only liability, but that just your vulnerability in your financial life is reduced. That's one of the things that Carly and I in these classes are trying to do, is help you guys to build good financial skills to be in a better place so that you guys live better lives. We want you to reduce stress. We want you to, when you think about financial things, we don't want you to cringe. We want you to think, hey, I've got this under control, right? We're here to help you. If you need help with any of those things, we're more than happy to help you. Feel free to give us a call, shoot us an email. But with that, we're here to help you, but also we want you guys to be able to help yourselves. We don't expect everybody that's watching this to become a client, but for those people that need the help, like, we are here for you. But just watching this, hopefully you can get some value. Hopefully you can say, hey, John brought up a couple good things that I think I can implement in my own life, just on my own. And if that's the case, I'm super grateful for that. If you need anything, feel free to give me a call. Like I said, I'm more than happy to try and walk you through any additional questions, or if you have anything that, that may be a one-off question that I didn't cover today, we can cover that on you personally. In the financial world, everybody's unique. You've got your own story, you've got your own financial footprint, fingerprint, whatever you want to say. And with that, you've got a lot of intricacies to it, right? How you react to things, whether that's pressure or whether that's good things, how you react to that. There's a lot of things out there that are going to make you unique when it comes to your situation. So these are not blanket, no blanket advice here, but these are some good, helpful suggestions to get you started on your way. And yeah, even if these things help you and later on you want to reach out and say, hey, I saw this video, these things really helped me. Even if you don't need any help, I would greatly appreciate that, just to know that, it is out there helping somebody. So, but yeah. So with that, today's a little bit shorter of a day, but that's what I've got for today. I hope that you guys had a good lesson from this. This is something that I think can provide a lot of value inside of your guys' lives individually. So I know, Jodie, we've been going a little bit longer on the other one, so I try to keep this one more manageable for everybody. But
it was great.
But yeah, reach out if you guys have any questions additionally. But hopefully this is a good starter for you guys to start improving your position financially.
I'm gonna have to have my my kids watch this one, definitely. It was some very good information, John. Thank you so much.
Yeah.
And thanks everybody for joining us today. Doesn't look like we have any questions, but as always, we'll get it up on our YouTube channel. And now our YouTube channel is nkchealth.org, but we'll get that up for everybody, and you can share that with anyone that you feel would benefit from it. And like I said, I'm for sure going to be sharing it with my kids. So thanks a lot, John, and have a good weekend and have a good Father's Day.
Thank you, Jodie. I appreciate everybody.
Yeah, talk to you later. Thanks, guys. Bye-bye.